Welcome back to the Ticks and Trades channel. We're going to look at what happened in the market for the past week, the week ending Friday, March 13, 2026. You are looking at a weekly chart of the SPY or the spiders, which is the ETF where we identify levels of support and resistance each morning before the opening bell. And we trade against them in the E-minis, which is the symbol ES. And today is Sunday, March 15, 2026, as I'm making this video recap. So the week in question is this most recent candle here, where price closed the week below the zone that we've been talking about for a few weeks. And if we zoom into the daily chart, we can see how the week developed, starting with this big break up candle on Monday. That's the green candle. Price looked weak at the open on Monday. They had gapped lower from the previous close on Friday, but they got a rally going and closed the day above this zone, and things looked okay. At that point, the bulls would have still needed to get above a trend line, which we'll talk about in a minute, and close multiple daily candles above it and this zone to possibly negate that pullback that we've been looking at here. But they started dripping for the rest of the week. So let's talk about the trend line. Where was the trend line that we kept mentioning in the morning game plans all week long? It was right here, based off the high of this candle from Thursday, February 26, to the high of this candle here on March 4. That was Wednesday, March 4. And you may ask, why these two pivot points? Why not use, say, this Monday following the pivot high here where price found a high and fell in a big way? That would look like this. So 2 points do make a line. That's correct. So this pivot high was important for a day or so. But in the case of this next lower high over here on Wednesday the 4th, we got an additional confirmation with a test, a retest here, and a rejection the next day, March the 5th. So the odds at that point were increased that any retest in the future of that trend line would possibly run into some resistance. And indeed, it happened all this past week. That's why we're keeping this trend line on the board until it's not important anymore. You might find it helpful to go over and check each of these daily recap blog entries. Over here on the Ticks and Trades website, Daily Recaps is the page you're looking for. And you can take notes of the levels and the game plans for each of these mornings for the week. And you'll notice that several of the levels toward the top of the chart each morning were in the neighborhood of that trend line. And those levels helped pull plenty of points and dollars out of the market this past week. So understanding the mechanics of that trend line and why it was important was, well, important for our trading this week. It helped inform us of some good trades. But anyway, here we are after the Friday the 13th close, and the price is still below this trend line, definitely below the zone. So let's talk about a couple levels to keep in mind for this upcoming week, starting tomorrow, Monday, March the 16th. One is this open gap from November 20, 2025. It has not been filled yet, and it is about 659.03 it looks like, and that's right on top of the 200 period moving average here on the daily chart. This area could represent some support if the bulls can defend it enough, and we'll need to take into account where price is in the big picture, which is to say the weekly and the monthly chart. So here on the weekly chart, price is just in the middle of nowhere. This area down here around 652.50 maybe to 652 is an area where price found some support in the recent past, at least all the way back here in October of 2025. So will this continue to work as longer term support? It might. We've got a line here thrown in at 652, just kind of splitting the difference between these lows. And we'll see what this looks like on the monthly chart. So 652 is still pretty much in the middle of nowhere. You know, we've been saying for quite some time now that price can pull back a lot and the overall market still be bullish in the big picture. This is what that kind of thing looks like. Will price continue to fall from here? Perhaps. But if it did, it would be normal, perfectly normal. There's a lot of room down there. But in the meantime, intraday and daily rallies are possible. Remember where price is on the daily chart? As of Friday's close, price is right near the bottom of this break up candle from Monday. So just like what you can get with a bear consolidation, like up here, where you have a breakdown candle and the price consolidates within the body of the candle a certain amount of time, they reach the top, resistance is met, and price falls, and the target is below the low of the breakdown candle. Well, we have a break up candle here. So after this break up candle on Monday, price mostly fell all week. Within the body of that candle, they're at the low. Will this be support? And another question is, are there other reasons for support down here? Yes, we just talked about a couple. The gap here at, what was this, 659.03, and the 200 period moving average, that's the black line upsloping here. So yes, while the big picture might have some room for price to fall some more, there are chances for the bulls to get some intraday rallies going in the meantime. Like, could you envision price maybe coming down on Monday or Tuesday this week, spiking below the low of this breakup candle, and probably spiking below this 200 period average here, and then bouncing from somewhere down here? It could take a day or two, but it is a possibility. Let's say that price gets below and closes several days below this daily 200 period moving average. That probably would not help the bull case. We've got this level down here, was important on the weekly chart, but if price gets below it, that's 652, closes daily and certainly weekly candles below that area, that would probably open the door a little wider for a more big picture bearish type of thing happening in the market. But if the bulls can get a bigger rally going, where would price need to get to for them to possibly be back in charge in a bigger way? Well, the story hasn't really changed from last week. Above this zone for starters, that's 672 to 675, and the bulls would need to get daily closes above that and this same trend line, which is getting lower with time. So the bulls can do it, but they might have their work cut out to do so. This week could get interesting. We'll talk about that in a minute. Let's go over to the transports, the DJT. So 20,000 is old news. We talked about what was likely to happen before they even got there. We also talked about this classic bear consolidation pattern. If you need a refresher on that, just go back and check last week's recap video. I'll put a link below in the description. What I want to show you now is that this bear consolidation has done some damage. And what it has done is put price below the low of what started it back here, February the 12th. So they're down here. And we also talked about there usually are targets below the low of these type of consolidations. So where are they now? They're at 17,700. Well, that was a level I put on the chart on Friday. If you go back to Friday's game plan, you'll see that we talked about the importance of the transports defending this 17,700 level. It can still be support. All day on Friday, they hung out. Here's a 5-minute chart. You can pretty much see they went sideways, hanging around this level, 17,700. And the point of looking at the transports here is that the transports often lead the rest of the market. The SPY does not look as drastic as the DJT, but the question I have is it only a matter of time before the SPY starts dropping harder like the transports have done? We can look at a weekly chart of the transports. They don't look too good. They need to defend this area, and there is the possibility they can bounce from here. It's showtime for the bulls to defend 17,700, and if they can do it, the SPY could enjoy a lift at the same time or shortly afterward. If the bulls cannot defend this 17,700 level and give it up, any drop in price from here will likely be reflected in the SPY. Again, this is just a gauge, more of a leading indicator. The SPY has its own levels of importance, as we know, but when price and time converge, especially across different markets, those are usually clues that will tell you where the next big moves are in the overall market. And we are looking at the SPY as the overall market. Now let's look at how subscribers to the Ticks&Trades daily levels fared this week using the levels and the game plans that were published each morning before the opening bell. So if we just look at the week in isolation, that is Monday, March 9 through Friday, March 13, all but one day gave us base hits. In the case of Monday, when price was climbing all day, we pulled 5 base hits at the levels. And on Tuesday, the one official trade hit the max loss limit. So the 20 points that we gained on Monday were erased the next day. Just go back to the recap blog entry on this day here, if you're interested, to get an understanding of what happened on that day. And the rest of the week was pretty typical, 1 and 2 and then 3 base hits for the last 3 days of the week. And that put the weekly rate of return at 4.8%. If you traded just 2 ES contracts at each level that was on the board for each day and followed the rules to a T, you'd have around $2,400 in your pocket for the week. And for the month of March so far, we're at a respectable 21.6% rate of return. So far, there's only been one day where we've given back dollar to the market in the first 2 weeks or so of March. And for the year of 2026 so far, we'll throw back in February and January. Let's take a look at where we are for the year. We are back above 40% rate of return, almost 42% to be precise, as of this past Friday. If you started the year with a $50,000 balance in your futures trading account and traded 2 ES contracts at each level every day, and equally importantly, followed the rules that govern the trade management, your balance would have grown to over $70,000. That is an increase of $20,975 in 2.5 months. That's what a 40% return looks like. And if a starting balance of, say, $5,000 is more realistic for you, and you traded just 2 micro E-mini contracts at each level, you'd have almost $2,100 added to your account. This trading approach is scalable up or down. And if you're asking yourself, well, if I had a $50,000 account, I would trade more than just 2 E-mini contracts at a time. Well, yes, that is true. You could afford to trade more than just 2 contracts with a starting balance of $50,000. Just like with a $5,000 balance, you could trade more than just 2 micros. It's just that the risk management approach that I use takes into account other variables. And because I prefer to be more conservative and let the base hits pile up over time, that's why I use a $50,000 balance and a 2 contract assumption. That should help you see what's possible if you're a more risk-tolerant trader. All this is explained, by the way, in the E-mini Trading 101 course over here on the website. Speaking of the E-mini contracts, the March contract expires this coming Friday, the 20th. It's options expiration week, and there's also a Fed announcement on Wednesday after the 2-day FOMC announcement. So 2 o'clock p.m. Eastern, there is the Fed interest rate decision, different announcements that are being made that should affect the market. So with all that going on, it should be an interesting week. We know that price in several markets is at a pivotal place, and that tends to happen leading up to these FOMC meetings. So keep your seatbelts fastened this week. The ride could get bumpy. We'll start trading the June 2026 ES contract this week. So back to the log here. That's it for this weekly recap. I hope you found some useful and actionable information in it. Thanks for liking the video. Subscribe to the channel and click the bell so you'll get notified each time a new video is posted. Trade well this week, stay disciplined, and I'll talk to you again soon.